On this video of the Bedroom Investor Stock Valuation series, we will be discussing what is the price-to-earnings ratio and how to calculate it. The price-to-earnings ratio, also commonly known as the PE ratio, the price multiple, or earnings multiple, is a valuation metric and is a powerful tool that is used by investors to help them assess the value of a company. The PE ratio is calculated by dividing the company's stock price by its earnings per share. Investors and analysts use this metric to help them determine whether a company's stock is over or undervalued. In addition to being able to use the PE ratio to help determine whether a stock is over or undervalued, the PE ratio can also be used to compare a company against the broader market as well as to analyze a company's historical performance. The PE ratio tells investors how much they are paying for a company's stock in order to gain exposure to that company's earnings. The price-to-earnings ratio is a ratio in which the lower the number, the better this is because the stock is cheaper. For a company that generates positive earnings, a lower price-to-earnings ratio means the investor is paying less for every dollar of earnings that the company generates. The PE ratio indicates the dollar amount an investor can expect to invest in a company to receive $1 of that company's earnings. The PE ratio is also known as the price multiple because it shows how much investors are willing to pay per dollar of earnings. Consider a company with a PE ratio of 30 times. When that company generates earnings and the investor decides to buy the stock, that means the investor is paying $30 for every $1 the company earns in profits. The PE ratio shows what the market is willing to pay today for a stock based on its past earnings or future earnings potential. So, what does a PE ratio of 30 actually mean? A PE ratio of 30 means that the company's current market value is equal to 30 times its annual earnings. Let's consider Ann's Coffee Shop and the total annual earnings it produces. If the market was to value Ann's Coffee Shop at 30 times its annual earnings, it would mean that Ann's Coffee Shop has a PE ratio of 30. This would mean that if you were to buy 100% of Ann's Coffee Shop's available outstanding shares, it would take 30 years for you to earn back your initial investment through the company's ongoing profits. However, the 30-year estimate would change if the company earnings were to grow or were to decrease. The PE ratio can have a range of values. A high PE ratio could signal that a stock's price is high relative to earnings and is overvalued. A low PE could indicate that the stock price is low relative to earnings and is undervalued. Let's look at how to calculate the PE ratio. This is stage 1. We will look at Ann's Coffee Shop, which has 1 million shares outstanding, and for the trailing 12 months, generated $200,000 in profits. Note that the TTM is equal to the trailing 12 months, and it means how much a company has made in the last 12 months. The earnings per share is calculated by dividing the number of shares outstanding by the trailing 12-month earnings, and in this scenario, we will divide the 1 million shares outstanding by the $200,000 trailing 12-month earnings that Ann's Coffee Shop produced. This calculation comes out to $5, so Ann's Coffee Shop produced an earnings per share of $5. We will now look at the second stage of this PE ratio calculation next. Now for the second stage of the PE ratio calculation, we take the share price of Ann's Coffee Shop, and in this instance, the share price is $10, and divide it by the earnings per share, which we calculated to be $5. So the PE ratio is equal to the share price divided by the earnings per share, which is equal to 10 divided by 5. The calculation comes to 2. Ann's Coffee Shop has a PE ratio of 2 times, and this means that for every dollar Ann's Coffee Shop makes, an investor who wishes to buy Ann's Coffee Shop stock is paying 2 times the earnings. Put another way, the investor is paying $2 for every $1 that Ann's Coffee Shop makes. Also note that the share price can be found by simply looking it up online, such as places like Google Finance. That's it for today's video. Watch our second part to this video, where we discuss the differences between the trailing and forward price to earning ratios. The link to the second video will be in the description below. If you found this video useful and gained value, then subscribe to our YouTube channel as we plan to release more videos in the future, where we look into depth about various financial ratios and learn how to analyze financial statements. You'll also receive notifications for when the videos are uploaded. Our goal is to make everyone around the world a better, smarter, and a more confident investor. So please share this video to someone you know who will gain value from this video. Thank you for your help in helping us achieve our goal. We'll see you again soon on our next video. Until then, happy bedroom investing!